Good morning, everybody. It is Nick, aka the Algo Cowboy here, and I've got Ben Kelleran with me on this lovely Tuesday morning, 11 a.m. EST. Take a look in the description. Got a couple of things for you. We have the paid sponsor, Algo Factory, free Algo in there. Check that out. It's good stuff. Shows you how to create an Algo, how to turn it into code using Grok, and the tools that traders use to connect their bot trading algo to their broker. More importantly, for this show, we got Ben Kelleran's data in there. We have, I think I got your Substack and your website in there. And as we always say, Ben is just a wealth of knowledge, especially when it comes to energy markets, but markets as a whole. And also, you got as good a chops as anybody on geopolitics. So it's always a pleasure to have you on, Ben. How you doing today?
Doing pretty good. Been interesting couple of weeks, but got a couple things market related I think are interesting to talk about, and then we can maybe rant on real estate affordability, what the you see stuff talking about property taxes and different things. I think there's a lot of stuff to talk about, but want to get into markets and energy and a couple other things that I think are worth a look this week.
Well, real estate's going to become way more affordable when my 540-year mortgage, comes into play, right?
Yeah, I mean, it'll be the generational, instead of generational wealth, it's generational debt slavery, which if you kind of look at the debt levels and deficits, that's effectively what the U.S. has done at a societal scale. But you take 50-year mortgages and, 100-year mortgages at this rate, then we might as well make it generational slavery on the individual level. So it's
That's what the Japanese did. Japanese have had 100-year mortgages for quite some time now.
Yeah, I mean, they also, it sounds like they have been less restrictive lately, but they've also been very upfront about what they want and don't want with immigration, and they've been able to keep a homogenous society. So it's, we'll see what happens, but I think Japan's gonna be fine. They might have some issues with the demographics, but they also are not in the same position we are here in the U.S. with what we've kind of done on that.
Well, everybody has the same values over there, more or less.
Yeah. Easy enough to do when you have basically a population that is, I think it's like, what, 98% Japanese, somewhere in there.
Yeah,
like
no one's telling them what to do with their borders.
Yeah. Well, it seems like that maybe has started to change, but it sounds like there's been some pushback. We'll see. I've one of the guys that you guys should try and get on the show, I think would be interesting, is Michael Yan, and he was talking about that recently. He's very, very sharp on a lot of different things, and he's also been very critical of Trump, which I think he's deserved. And the thing about the upcoming midterms here next year is, unless Trump figures out something as far as actually catering to the base, no one's going to give a shit about turning out in big numbers for a lot of the midterms on the federal level. So we'll see what happens, but I'm pretty pessimistic about what Trump has been doing and talking about. And I mean, I guess I shouldn't be all that surprised, but when they're not going to do anything for the base, then they shouldn't be surprised when the midterms turn out to be pretty ugly next year, which is kind of what I'm starting to expect.
Yeah, don't let Tom Longo here talk like this. He's not gonna like that.
Yeah, I'm pretty cynical about some of the political stuff, but I guess that's just part of growing up when I did. But yeah, unless the plan starts to be more obvious, then trust the plan is not where I'll be. So
yeah, I mean, if you look at it this way, like, this year's elections really don't mean anything. You had a few mayors or whatever. But I think that what Trump might be doing, if you do listen to Tom Luongo, which this part actually makes sense, everything's got to be done with an order of operations. So he's probably just handling, by that rationale, international issues at this time. And then leading up to the midterms, that's when the more local issues will get handled. So, I mean, I don't, I'm beyond cynical. I'm so far like black pilled that I'm not even black pilled anymore. I'm just like, whatever, it's not a whole lot changes in a way. Like we saw a lot of the insanity happen with the woke this and the other. And, that was going on like, I don't know, from 2016 forward. As soon as Trump kind of got in, all the woke stuff happened. So they tried to change the fabric of society. And anyway, I think that I think society's not going for it. So I think that, I don't know. I think there's enough fertile ground for the upcoming election not to go too badly. But yeah, they're going to have to make some ground up for sure.
Yeah. The the markets have been interesting. I'm sure you've been following this to different degrees on different sectors and whatnot, but seems like the FinTwit types are all freaking out about, markets below the 50-day for the first time since April. And I mean, I kind of look at that and the tech. Apparently, some people are banking on NVIDIA earnings to save it, but we'll see on that. But the whole reaction from people that comment on financial Twitter and all these different places, it's kind of amazing to me that we're 5%, not even off the highs, 3%, whatever it is. But it'll be interesting to see how long they let it go before the plunge protection team comes in on the S&P, because this kind of goes back to Luke Groman's argument on where, right, if you get stocks down far enough, then it starts to hurt the treasury market. And yeah, I mean, it's not a system that I think is great, but it's a system we have. So one of the things I think is really interesting is how well energy has been holding up in the last, I'll share my screen here on this. In the last,
SP will go to 6150. That's where I think it goes.
Yeah. I think another 5-10% on S&P is probably needed, but if you pull up the screen share there,
yeah, I gotcha.
The thing that's been interesting to watch is like money started to rotate, like as SP started to roll over, money started to rotate into stuff like OIH and XLE and XOP, a lot of the energy stuff. You can kind of see the way this is holding up, where it's like, okay, market's down 1.5% if you're looking at tech heavy NASDAQ, and a lot of the energy ETFs are not down as much. And you see, like if you look at, like if you just zoom out to the all-time chart here on XLE, right, when this thing breaks, I mean, basically round number bingo of 100, right? That's like an all-time high, and that's with oil being at $60. And so,
can you tell the audience what XLE is?
XLE is basically the big energy ETF. I mean, it's I think 40% Chevron and Exxon, so the big guys, but it has a mix of services, refiners. It's kind of the basket ETF for overall and energy exposure, and not as specialized as something like OAH, which is services, or XOP, which is just producers, or was it crack, I think, is the refiners ETF. That's a great ticker, but I don't know how they got that one. But basically, like if you look at where this is, like if you kind of told a lot of people that energy would be looking at 2022 just chopped sideways while oil got smoked post Russia Ukraine situation, right? I think there's a lot of upside on energy, especially if you get oil eventually breaking higher in 2026, which I think is probably going to be coming. And the other thing that I think is pretty interesting is you have, like, I've listened to, I don't know how many podcasts in the last week where the guest has basically said, yeah, I think we get a flush or a washout in oil before we head higher. And so like consensus is still like pretty bearish on oil, but you have a lot of money moving into some of these equities, especially if you look at like long-term charts and where all that stuff's going. But I think especially the last like month or so, it seems like money's starting to rotate into some of the energy space.
Morning, V.
Good morning, gentlemen.
Yeah. So
how's it going?
It's going. It's foggy morning here in Boise, but how are things on your end?
'Tis another day, my friend. 'Tis another day. I'm hanging out, relaxing, taking it easy. Not relaxing at all. Just doing what I can.
So with you have the crack ETF, right? Or XLE actually. So XLE is basically chopping at highs, right? And yet oil is getting smoked this whole time. So is that telling you that other energy is making up the gap, or is it speculation, or why would oil be getting smoked and yet your energy ETFs are chopping around the highs?
I mean, I think part of it is the post 2020, a lot of the energy companies got extremely cheap and they used the 21 and 22 to fix their balance sheets basically. And they're in way better shape than they were from 2014 to 2020 with the shale boom and what they're spending there. But like, even if you look, this is just the crack ETF off the bottom in March, and it's basically up, what was that, 60%? And there's a lot of you kind of look at what has happened since like the giant tariff panic puke in a lot of these things, and you go back and look at like long-term charts of where OIH is and some of these different stocks and the subsectors. I think there's a lot of people positioning for higher oil prices is kind of in 2026 is what I'm kind of guessing. But you also have like broader commodities like looking like they're ready to make a move here, especially, I mean, we had the peak in 2022 and you've got what I think is a pretty interesting setup, even as the markets are, I mean, what, down percent. And I think it's like, you probably have to have a bit of a sell off here for people to like stop going and buying, was it like Algo and all these other like quantum shitcos. Like this company has no revenue. Was it Rigetti Quantum Computing? It's another one where it's like, look, this is a speculative blow off in a lot of the junk in the market, but I think there's a lot of good companies out there. Like, and this brings me to natural gas, which I think is a really interesting setup for the winter. This is Antero, which is one of the bigger U.S. natural gas producers. But you kind of look at the setup on gas in particular. If where is it? There's a lot of reasons to expect. Basically, I wouldn't be gambling specifically on like natural gas prices in the futures because that's just not my area of expertise. But you have a setup where I think the weather could basically be pretty cold from what I've been hearing this winter. And that's with natural gas being where it is, I think it's something where the stocks are not reflecting much higher prices, and these stocks can go on a tear in short order if things kind of get cooking as far as natural gas prices. I think, was it up to $4 and change in the last like month? So had a pretty big run, but it's one of those things where longer term, like you're looking at 5, 6, 7 on natural gas. And over the next couple months, like it might be an interesting short-term trade with some of the equities that I think are still pretty cheap as far as like actual valuation stuff. So I bought a small slice recently of Antero, not a recommendation or anything, but I think it's pretty interesting setup for next 3 to 6 months, but probably even longer.
I know we're not really talking about this, but what's your guys' opinion on quantum computing? Is it bullshit? Is it real? Will it be real one day, or is it all just like vaporware?
I think it's real as far as we're going to keep trying to develop the technology. The stocks, as far as like an actual investment, that's not real. That's hype. But I think there is like, this is not my area of expertise at all as far as the technological side, but I do think we are going to see some interesting developments on that front as far as the actual technologies. There's one stock that I bought recently that's sort of exposed to it, but basically from the semiconductor side. But it's yeah, I mean, I think quantum is real. I don't think the stocks in the sector are worth owning. I think it's going to be interesting to see how the technology actually develops, though. So,
what do you think of that, V? Do you think quantum is, vaporware, or do you think there's something to it?
I don't even know what quantum is.
Quantum computing.
I don't. I think it's. I don't know much about it and really comment, honestly. I think it's a bunch of horse shit, but we'll see. It's probably real, we just don't know.
Well, if it's, you have to think about it this way. If it is real, then all of your cryptos mean nothing.
Oh, 100%. Well, here's the funny thing, though. The Chinese are using quantum radars in order to, track U.S. jets, especially stealth. So stealth is a moot point at this point. If quantum computing is really real, yeah, the cryptos are a moot point. There's no point for cryptos anymore.
Yeah, but there's no point in cryptography anymore at that point.
Correct. Unless you develop quantum cryptography.
Yeah, and who can afford that?
I don't know who can even make that.
Yeah, at that point, you might as well just own pieces.
That's why it's better that we continue to create outstanding dick pic applications
in the U.S.
Yes.
Yeah, right. That's what we do here. But yeah, I'd say it's always good to back up. Just to back up whatever kind of wealth you have in actual physical assets, because in the end, if quantum computing is a real deal, then whatever you got is gone. Gulag, I've looked into it, and it doesn't seem like Bitcoin's doing anything. They can't upgrade later. They have to upgrade now. So it's the same thing as, someone's going to break into my house. I'll get a gun one day. Like, no, you have the gun now.
Yeah, you don't buy fire insurance when your house is on fire.
Right? Yeah, right. That's just the same thing. So it can't be we will upgrade. It's got to be upgraded now. So, and from what I understand, they're doing nothing about it with Bitcoin. So I don't know. Either quantum is fake and whoever's running the game knows it, and so they're not worried about it, or quantum is real and whoever runs the game knows that, and they're fine with everything going down, or whoever's running the game is really not aware of things, which I really doubt. So there's one of those seems realistic to me, is that they know it's BS, and so they're not worried about it. That's where I see it. But I'm not hearing any efforts to upgrade. So anyway, I know that wasn't what you came to talk about, Ben, but it's something that is always a conversation in the speculative market, right?
Yeah. Well, I think you look at Bitcoin recently, and this is, again, not my area of expertise, but you kind of see what's been happening here. It's like, I'll let other people speculate on whether it's BlackRock dumping or other institutions getting rid of it, but it's a pretty big move since the beginning of October, really. And
huge. Yeah.
There's some different things that, we'll see what happens with the liquidity, but I don't know if I'm watching from the cheap seats. I don't own any Bitcoin. It's just not for me. But one area where I kind of have this kind of fascination with what they've done as far as issuing preferreds and like using it to finance Bitcoin purchases, MicroStrategy. And this thing he's a
genius, bro.
This thing is gonna be a spectacular implosion when it does blow up.
Oh God, yeah.
And I am kind of looking forward to it. Like there was let me see if I can find his
Some men
photo
just want to
tweet
watch the world
where
burn.
he's like got the AI generated Titanic and he's like on the lifeboat. Yeah, here it is. This is so funny to me. It's like
he's forecasting he's gonna get a golden parachute as his investment hedge fund fails and all his clients try to sue him.
yeah,
That's what he's forecasting. I mean, I got a price point of 26 to 28,000 on BTC, man, in a bear, and Cowboy's right there with his sentiment as well. It's like this thing it's because it's horse shit at the end of the day, man. It's horse shit.
Well, every bull goes down about 85 to 90% for the bear. So it's predictable. That's what it does. So what's been, and we talked about this morning with Algo Factory, but what's changed is that it doesn't go up as much each bull cycle. Like every bull cycle, it's almost like not an order of magnitude less. Sometimes it's more, but as time has gone on, it's been less bullish, and that's typical as new assets start to proliferate. But by the same token, look where all that volume is on the chart. It's all in the bear, right? So that's where that right there, all that volume there, that's where all the smart money bought. So you got to think about that. That's where all the transactions happen, all the panic selling and the smart money buying. It's all right there.
This is
all the dumb money bought the top and held
year.
onto it.
This is the 3-year markup here, is what this is.
Mm-hmm.
So, I mean, I look at it as like, okay, we'll see where it goes. I don't really see much use for it for me personally, and I think there are stocks that I prefer as far as currently, but it is kind of one of those things where you go back to what happens when they open up the liquidity pump again. And this is guy that's, I think, pretty interesting. Pretty sharp guy and definitely on the generational issues. But everyone's kind of talking about, okay, market's got to sell off a little bit, and then we get some liquidity, and then we see where it goes from there. But I think it's going to happen pretty quick when, like, this goes back to, like, you can't let the markets actually function like they would years and years ago. It's like they're going to panic if we get to S&P 6,000, or, I mean, basically the same thing where you saw, okay, S&P 6,000, 20% haircut, and then, oh shit, we got to make sure to pump the markets. And so it's like, yeah, could we get a bit of a sell-off here? Sure. I don't think it's going to be as bad as April was, where everything just gets taken in the backwalk, like the basically drawn down with it. But we'll see. I think it's going to be rougher go for tech and those sectors, and other places I think are actually cheap and where I expect money to like actually start rotating. So
the problem though is that tech is being held up by so much borrowed money. So even if the rest of the sectors are not fundamentally affected, they're going to have to sell all of their holdings to cover the borrowed money for their tech bets. And this is why the contagion goes beyond sectors. So the tariff tantrum was over 20%, 21.62% in the SP 500 was how far it went down. Right now, we are, I'm just looking on a chart that you cannot see, and that's okay. We don't need to bring it up. But we're approximately like 5% off the highs right now. And to come down to where I think we're going to start to see some, final support, or I should say finally see some support, is at 6150 S&P, like we talked about earlier. And that's an 11.5%, literally half of the move down that we saw the tariff tantrum.
Yeah, I mean, that's kind of the 200-day, and we'll see kind of where actual buying shows up, but I think it could be a couple months here of interesting tough sledding, especially for the tech stuff. And You see it with different things. I mean, if it gets what's Nvidia earnings is tomorrow, I think. This is so funny that like this is like a one company earnings like is some massive market moving event, but when a stock gets to this size, it shouldn't be all that surprising, I guess. But right, if you kind of see Nvidia take a nice puke on earnings, then it could flush the S&P pretty quick, where it's not just like 2-month, 3-month drawn out thing. It's like, all right, we are gonna do this correction in fast mode. So who knows?
Nvidia is like 14% of the Nasdaq, so it's very visible if Nvidia creators, right?
Yeah, I mean, go look at like all these different charts. You kind of see, was it SOXX as the semiconductors, right? You see basically, okay, late October, everything kind of has the same chart, and this is why I think I want to go back to a market that is individual stock based and not based on these ETFs. Because you look at NASDAQ, you look at semiconductors, you look at the S&P, like it's basically all the same chart, right? It's okay. There's slight differences, but there's not much that is moving in right to the beat of its own drum. But we'll see what happens. I think we're gonna look back at like the financialization and the 2 times levered ETFs. There have been a couple that I just look at. It's like, look, we don't need more single stock like levered ETFs. It's just dumb. It's adding tinder to a brush fire that we just don't need. And if the regulators weren't asleep at the wheel, like they would just say, like, look, we don't need this. If you want leverage, go buy calls. Like that's where it should be. Like calls, puts, whatever, right? Do your own thing on the derivatives. We don't need ETFs to make this bigger, like more volatile and more basically just more potential for a shit show. So
Well, I mean, that's just a way for, certain people to make money, but, fee income, basically. And they can play their own games with it. But I think the world's moving towards private equity anyway. There are, I forget the statistic. I heard it recently on Joaquin Flores was talking about it, but there's been a very definite downturn in not only the amount of listed stocks, but the duration that companies go and stay public. So a lot of companies are staying private entirely, or they're being taken private, or they're staying private for a much longer period of time before they go public. And I think that's a reflection of just, everybody understanding that the market is BS, right? So we may have a return to private equity where people are going to be more interested in, owning a piece of a company through contract or maybe bond or something, right?
yeah. Have you guys heard about this whole Blue Owl private equity, private credit deal?
No, I haven't heard about it.
So this is the same CEO that Jamie Dimon was talking about with the private credit cockroaches, and basically here's the short summary of it, and I'll zoom in here. Basically they blocked redemptions and then forced a merger with the fund, and so they're instant 20% haircut for investors, and so that leads to redemptions. And I mean, I think private credit is probably got the most toxic sludge of any asset class really out there. I think private equity makes sense because people look at public markets and just like, yeah, we don't really want a part of that. But as far as where some of the shit could come to the surface, I think private credit, like just go look at the charts of some of these stocks over the last 2 months, right? A lot of these have taken like big time haircuts. I think was it KKR like a lot of these asset managers, that Apollo's another one. I think they're not as maybe not as exposed to it as some of the others, but
Are these like private credit companies that invest, or are these
these
publicly
are
listed?
asset managers that have like massive private credit exposure. Yeah.
Gotcha.
And
Like private credit? Do you mean credit in like privately owned companies, or just private credit? Period.
so basically, it's the debt equivalent of private equity, right? So they're going to companies that are in need of debt, and they will raise a fund, lend out to these companies, and right, that's how they collect their return. But
Gotcha.
the you look at the amount of assets that's been shoveled into private credit, they are now trying to dump that on retail and if and pension funds and all these different things. And so they need exit liquidity just like the private equity guys need exit liquidity, right? And you look at the number of transactions that have been happening, like private equity transactions. I'll see if I can find like a quick chart here. But like they are down significantly in 2025 as far as actual volume. And so, right, if your whole strategy is built on being able to exit, then yeah, here you go. This is
That's kind of my point, though. If private equity has a much harder time exiting because they don't have the stamp of approval from NYSE or whatever, that ultimately is going to be like, well, we better invest in some decent stuff because we might not be able to get out of it.
well, that's the thing is like I have no problem with like the private businesses versus public or anything like that. But the idea that we should be like reliant on playing musical chairs with some of these private companies and turn it into this asset stripping game, and then we dividend out and all this other bullshit that goes on. That I mean, you talk about what's happened to dentist office and veterinary clinics and all these other things that private equity guys love to roll up, and doesn't make the service better. It doesn't like improve the business, except for the owners can cash out of it. And I think that's what you're seeing is like, if you're an investor, why would you want any exposure to something that is illiquid? The valuations are not cheap and you don't really know what you own. And that's where I'm like, okay, I'm totally fine with private markets to stay out of the casino, but it should be something where you're absolutely fine owning it, right? And that's where I think this is going to come combined with interest rates being higher than they were, right? All this stuff works a lot better with interest rates at 0 or 1 or whatever it was. But I think it's when you see all this activity that's basically moving out of the banking system and into the asset management firms, right? That's where you get back to these charts. And from my understanding, Blue Owl is like the worst offender. And you kind of see that with their fund and people getting rid of it in the last, like, I don't know, really since the start of the year. It's been cut in half. But point is, like,
that's the market doing its job, though. So
no, exactly.
These guys are offending. They're not doing things right, and their company goes away. In the meantime, you got public companies like NVIDIA, and they can just make stuff up, and all of a sudden they have $500 billion in the balance sheet. So what'll happen as long as this kind of privatized equity is, everything gets abused. You're always going to have BS in every kind of circle. And obviously it's not a perfect system, but it seems to me that the egregious greed is through the public system at this point. And I say public, I mean like going public, like the stock market, that kind of thing. At least these companies take a haircut when they make a mistake.
Yeah, I mean they've been getting punished, and that's where I think it could be. I don't think it's maybe systemic, like gonna bring down the banking system, but is it gonna be painful for a lot of these guys that have basically made small fortunes building up asset managers in the last, I don't know, 4 or 5 years, probably. But that kind of brings me to probably the best Substack post I've seen in a while, and I'll
Can
see
you
if I can
zoom in on that?
Yeah, I'll see if I can.
Yeah, there you go.
Yeah, and then I'll send a link to you, and you can maybe drop it in the comments section. But basically, Mike Green has been one of the guys like sounding the alarm on the whole passive trend and some of the shit going on there. And he's like wicked smart. He does work for, was it Simplify Asset Management, but they have some interesting ETFs and whatnot. And he gets into a lot of like financial market stuff, but then this one was focused on like the whole working class and affordability issue that we've kind of talked about a little bit. And there's kind of the disconnect of what people want and what the system can currently do, the way things have been financialized. And right, you kind of do the math on where home prices are now, and a lot of different things. Like he goes into detail on the kind of social engineering stuff they've seen and what's happened to different generations. But like you basically say, like you look at the affordability of some of these things, and there's just no way for most of the younger generation at current prices to afford a home. And we'll see where that goes. But I kind of look at it as like, eventually we're going to need lower prices and not just lower interest rates. Because I think you might have to correct me on this, but the cost of owning a home since 2020, I think, is up like 70%. And some of that is mortgage rates, but a lot of that is the housing prices. And
But Ben, don't you think 100-year mortgage would solve this problem?
Yeah, I mean, I'm definitely excited about the potential generational debt slavery option, but I mean, it's one of those things where you kind of right. This is the part that I mean, I was like, yep, this is what the game plan was from like the older generations. Like, yep, go to college, get a job, you'll have believe in diversity. This is one of my favorites, but the go to college, get a job, do all these things, and you'll be able to afford the American dream. And now it's basically you have certain generations moving the goalposts on like what you should be able to achieve without some Herculean effort. But this is where you can kind of get into how much income is actually like people say, oh, like I want to make 100,000, or I mean, 100,000 today is basically like what, 200, probably would have been like 50,000, like 2,000.
I mean, you live in a place like New York, 100 grand is nothing. It's like 100 grand is the new 50 grand a year. Correct.
That's exactly right. Where it's like a lot of people where it's like, yeah, I got out of college and I was making 50, 55.
Yeah.
And it's like, look, your rent was $500 a month when that was the case. And you have healthcare costs, like all these different things that are basically, I mean, this is definitely something worth checking out and reading instead of me just like skimming over it. But I think he did make it free for everyone to read. So,
you know, I actually did a research how many years it takes at the median salary for people to pay off a home, and it's harder than it used to be, certainly. However, what people did even back when, like in the 70s, and you know, when it was easier to pay off a home, when it was like 3 years versus 5 or whatever it is, they even then they got roommates. they save their money. And that just, even now with things, sure, they're harder, but these kids are also really not very responsible. So the way I see it is, okay, sure, we're in this situation and there's a lot of inflation and there's the housing crisis and there's this and there's that. But it seems that it's kind of a double whammy because these young kids, just like it said in that article with, go to college as demanded, pursue your dreams as demanded, believe in diversity as demanded. Experiences are better than things, like all these silly things that they're being taught. And I think the new generation, like the younger Zoomers, the younger Gen Z, and the new generation Alpha, I think they figured it out. But even 50 years ago, people were just like, if they wanted a house, they saved their money. Like, and no one cares to do that. It's like we're turning into Argentina. Gus talks about it, and I've heard about it since before Gus talked about it. When you have so much inflation, like runaway inflation, kids are hopeless. So they'll YOLO. And that's what they're doing now. They're YOLOing. They're spending like $100 on DoorDash when they can spend like $8 and buy stuff from the grocery store, or 15 or 20.
Yeah.
So I do put the responsibility on the young people as well, right?
Well, at the individual level, it's always going to be like, what are you doing personally to try and improve your situation? At like a societal scale, like it's not like you have to be aware of like the certain trends, and I definitely understand like between inflation and healthcare and housing costs and all these different things, right? We can try and save money, but it's not like incomes have kept up on a real purchasing power basis. So that's where
you got to do the best you can. But like no one, like people want to have their own place right after college. It's like, that's not realistic. That was never ever realistic in life ever. Like even 50 years ago, people would just get out of college and they're making comparatively way more than they make right now, but they still had roommates.
Yeah.
They still, so I put it, the young people voted themselves into this position, and you're not going to vote yourself out of it. So either you're going to do the best you can or not.
Yeah. I mean, it'll be interesting to see. I think the tough part is I don't know how you get people on board with some of these different changes without some of the generational turnover I've kind of talked about before. But it's certainly one of those things where we're gonna see this become a bigger and bigger issue, and this is where kind of the financialization and the distortions that are created by it, where that kind of comes into play. So I think it's just something to keep an eye on. Like there's a lot of stuff that's interesting in markets right now, but that's kind of what I had for today. Is for anyone looking for that post, like definitely go check out, just Google like Mike Green Substack and you'll find it. But yeah, the thing that's worth checking out is that post. Definitely worth a read. I think it's free for everybody, but I think we're in for an interesting stretch of markets here. I think probably get a bit of a correction, see where that takes us, and then we'll see if NVIDIA earnings can save the day tomorrow. But yeah, that's.
Well, I've got the Mike Green link, and I'll throw that up in the Discord.
We need Larry Ellison to write another memo.
I'm going to give you my Krusty the Clown. The exasperated Krusty the Clown.
Sheesh.
Good times.
Come on, that was dead on.
No, it is.
Now let's do. I'll put the link to the Mike Green article in the Discord under Algo Cowboy. Y'all can go check that out. Guys, do you have any final thoughts?
No, great show, Ben.
Yeah, just
good, great analysis work.
Keep an eye out for what's going on in markets. If we get cold winter, keep an eye on natural gas.
Yep.
Anyone that does kind of focus on markets, I think there's stuff that's cheap that's out there, but it is not going to be in your big cap tech. So
yeah.
Yeah, well, you could always depend on Ben to have kind of like the calmer, look at things, right? Because a lot of people get excited. I tend not to get excited, but it doesn't mean you're going to get it wrong. But it's just there's always that flavor of like, hey, let's just take a look at this, and this is what we see, and that's always refreshing for some people as well. So Ben, thanks for coming on. V the Gorilla, you got anything before we go?
No, that's it. With that being said, folks, we're at the end of the program. We'll be back tomorrow, locked and loaded, right here with Gus. Take it away, Cowboy.